Good afternoon, distinguished ladies and gentlemen. Good afternoon, ladies and gentlemen. The Monetary Policy Committee met on 21st and 22nd of September 2015 against the backdrop of lingering uneven recovery in the global economy and slowing domestic growth. In attendance were 10 out of 12 members. The committee reviewed developments in global and domestic economic and financial environments in the first 8 months of 2015 in order to provide the policy direction for the rest of the fiscal year of 2015. The committee observed a divergence in global economic environment with a gradual but steady growth in the United States and United Kingdom, but a slowdown in emerging and developing economies. The underlying drivers of growth in the advanced economies included improving financial conditions and consumer sentiment, suppressed commodity prices, and favorable labor market conditions. On the flip side, the slowdown in the emerging and developing economies is mainly attributable to tight external financial conditions, mostly a direct consequence of reduced revenues from weak commodity prices, fragile global demand, and other geopolitical factors. Aided by strong consumer spending, continuous improvement in the housing and labor markets, and wage growth, the United States continues to benefit from soft energy and other commodity prices, evidenced by the country's revised second quarter 2015 GDP growth of 3.7%. Growth outlook in the second half, however, remains moderate as exports could slow on the heels of a strengthening dollar and slowing growth in China. The Bank of Japan maintained accommodative monetary policy through its assets purchasing program with monthly injection of 6.7 trillion Japanese yen, resulting in stronger than anticipated second quarter growth. Following its September 3rd, 2015 meeting, the European Central Bank ECB retained its key policy rate, even as its assets purchase program continued while inflation remained largely subdued. In the United Kingdom, the Bank of England also continued its assets purchase program as the economy maintained a robust growth path in the second quarter with a modest uptick in inflation. These developments have started to trigger the debate over when the Bank of England will start raising its rates. Mindful of the potential impacts of a rate adjustment, particularly on the emerging markets, and considering the sluggish recovery in the euro area and Japan, as well as the need to firm up recent growth and employment gains in the domestic economy, the US Fed voted at its September meeting to maintain its key interest rate and delay monetary policy normalization. The decision is expected to strengthen stability in global economy and moderate volatility in the financial markets, while also consolidating recovery at home. In the emerging markets and developing economies, expectations of low growth continued into the third quarter of 2015, with strong likelihood of moderate uptick in 2016. Output growth in China at 7% in the second quarter of 2015 is expected to moderate further due to slower productivity and exports, collapsing assets value, and excess capacity in the manufacturing sector. Global inflation is expected to remain tepid as the recent temporary rebound in oil prices and stronger consumer sentiments have mildly raised consumer prices in the advanced economies. Consumer price developments were mixed in emerging and developing economies. Commodity importing economies have continued to benefit from low global oil and other commodity prices, while others, especially exporters of primary commodities, are contending with increased pressure on their currencies and fiscal positions, and in some cases, significant inflation passed through to domestic prices. Domestic economic and financial developments. Output growth in the first half of 2015 trended downwards from the level in the fourth quarter of 2014, mainly on account of softening oil prices. According to the National Bureau of Statistics, real GDP grew by 2.35% in the second quarter of 2015, a significant decrease when compared with the 3.96% and 6.54% in the preceding quarter and corresponding period of 2014, respectively. Real GDP growth is projected by the National Bureau of Statistics to stabilize at 2.63% in 2015, compared with the 6.22% recorded in 2014. The non-oil sector remained the main driver of growth in the second quarter of 2015 at 3.46%. The key drivers were services, trade, agriculture, contributing 1.80, 0.95, and 0.82 percentage points respectively. On the other hand, oil and natural gas sector declined by 0.73 percentage points, an improvement of 1.13 percentage points relative to the first quarter of 2015. The overall outlook for economic activity is expected to improve on account of sustained improvement in the supply of power and refined petroleum products and progress with counter-insurgency in the northeastern part of Nigeria. Committee reiterated its commitment to efforts in support of the various ongoing federal government initiatives to stimulate output growth. The committee noted that the year-on-year headline inflation edged upwards to 9.3% in August from 9.2% in June and July. The increase in headline inflation in August reflected marginal increases in both the core and food components of inflation. Core inflation rose to 9% in August from 8.8% in July, while food inflation increased to 10.1% from 10.05% over the same period. The committee observed that the uptick in inflation was mainly traceable to higher energy prices, delayed harvest, and pass-through from imports. It, however, noted with satisfaction the continued moderation in all measures of month-on-month inflation across all the measures. In August, on a month-on-month basis, headline inflation rose by 0.59% from 0.69% in July. Core inflation rose by 0.61%, same as in July. Month-on-month food inflation also moderated to 0.63% in August from 0.77% in July. The committee, while reiterating its commitment to price stability, noted that the rising inflationary trend was a concern given the already tight monetary policy stance of the central bank. Broad money supply, M2, contracted by 2.23% in August 2015, below the level at end of December 2014. When analyzed, M2 contracted by 3.34%, which was significantly below the growth benchmark of 15.24% for 2015. Net domestic credit rose by 11%, which analyzes to 16.49% in the same period. At that level, net domestic credit was within the provisional benchmark of 29.3% for 2015. The growth in aggregate credit was attributable to growth in federal government borrowing which reached 140% in August 2015, or 210% when annualized. During the period under review, rates in all segments of the money market were largely influenced by the level of liquidity in the banking system. Money market interest rates were relatively volatile, reflecting fluctuations in banking system liquidity during the period. Average interbank call and open buyback rates, which opened at 10.85 and 10.65% in June 2015, closed at 31.07 and 28.1% respectively in August 2015. Average interbank call and open buyback rates for the period were 14.95 and 17.17% respectively. Committee noted the bearish trend in the equities segment of the capital market during the period under review. The all-share index decreased by 9.3% from 33,456.83 on June 1, 2015 to 30,332.68 on September 18, 2015. Similarly, market capitalization fell by 8.8% from 11.42 trillion naira to 10.42 trillion naira during the same period. However, relative to the end of December of 2014, the indices decreased by 12.5 and 9.3% respectively. The decline in share prices year to date was largely due to the subdued sentiments preceding the general elections, which held in March, and concerns for the country's foreign reserves position due to the declining global oil prices. The external sector development. The average Naira exchange rate remained relatively stable at the interbank segment, but significantly volatile in the borrowed exchange segment of the foreign exchange market during 196.7 Naira to the dollar at 98 kobo in 2015 period. It opened at 111 Naira 13 Naira in the interbank market, attributed consequently crossed official dollars at the end of July on September 17. Environment performance. Committee noted that growth had come under severe strains arising from declining private and public expenditure. In particular, it noted the impact of non-payment of salaries at the state and local government levels as a key dampening factor on domestic demand. Year-on-year headline inflation continued to trend upwards, although the month-on-month measure moderated. Demand pressure in the foreign exchange market remained significant as oil prices continue to decline. Arising from these developments, there were indications that some of the banking sector performance indicators could be stressed if conditions worsen further. Specifically, committee noted that liquidity withdrawals from the implementation of the Treasury single account, elongation of the tenure of state government loans, as well as loans to the oil and gas sectors, could aggravate liquidity conditions in banks and impair their financial intermediation role, thus affecting economic growth unless some actions were immediately taken to ease liquidity conditions in the market. Having seen 2 consecutive quarters of slow growth, committee recognized that the economy could slip into recession in 2016 if we're not going to revive growth in key sectors of the economy. In the face of prevailing circumstances, committee acknowledged that synergy between monetary and fiscal policies remained the most potent option to sustainable growth. The committee further observed that the impact of the persistent decline in global crude oil prices on the fiscal position of government continues to reflect in rising credit to government. The committee also noted that the initial market reaction to the decision by JP Morgan to exclude the country from its government bond index for emerging economies had largely dissipated as yields soon adjusted to their pre-announcement levels, adding that there may be second-round effects over the next 2 months as the economy adjusts to that decision. The committee reiterated its unwavering commitment to Naira exchange rate stability despite the pressures, mindful of the possibility of diversion of any extra liquidity to the foreign exchange market. Committee urged the bank to closely monitor the nature and sources of demand pressure in the foreign exchange market to ensure that funds were not diverted to demand for foreign exchange but applied to specific growth-enhancing asset creation lending by the banks. It further noted that sectors such as agriculture and micro, small and medium enterprises and must therefore be painstakingly. Committee was optimistic pressure on enhancing measures would overshoot prices. That business unfold its economic plans of the administration at the sub-national level would underscore the imperative and building fiscal buffer, which is essential. The Monetary Committee also observed that despite the Treasury single account, banking system liquidity ratio remained moderate. Consequently, committee advised on the urgent imperative of banks to aggressively support the efforts of government at job creation by channeling available liquidity into target growth-enhancing sectors of the economy, such as agriculture and manufacturing. This is with a view to promoting employment creation through conscious efforts aimed at directing lending to the growth-enhancing sectors of the economy. Committee considered that the bank and deposit money banks must strive to reverse the slowing gross domestic product trajectory by actively stepping up their efforts in catalyzing the economy with substantial new loans to the target sectors earlier highlighted. Committee's decisions. In consideration of the underlying fundamentals of the economy, particularly the declining output growth, rising unemployment, evolving international economic environment, as well as the need to properly position the economy on a sustainable growth path, the Monetary Policy Committee decided by a vote of 7 to reduce the cash reserve requirement ratio from 31% to 25%, while 3 voted to hold. By a unanimous vote, MPC voted to retain the MPR at 13%. In summary, the MPC voted to 1. Reduce the CRR from 31 to 25%. 2. Retain the MPR at 13%. Retain symmetric corridor at 200 basis points around the MPR. And 4. Retain the liquidity ratio at 30%. I thank you for listening.
Distinguished ladies and gentlemen, that was the communique as presented by the governor. It is now time for questions and comments. And just to remind us what the House rule says, that we limit our questions and comments to issues raised in the communique. So, any questions, comments, just indicate, come up here, tell us your name and the organization you represent, and then your question, please. Yeah.
Good afternoon, sir. My name is Ugo. I work for Premium Times. So you said that the TSA has not really impact beyond moderation. So how moderate was this impact on the economy of the TSA policy?
Any more questions, comments?
Caesar from PNT. It's just a follow-up to God's question on the TSA. How safe are our banks now following the TSA policy? Because there has been a lot of speculations that the bank have a really shaky time because of the TSA.
Okay.
My name is Bill Dale from Radio Nigeria. I'd like to find out what has been the impact so far following the restriction of foreign exchange in some sectors of the economy.
Following what? Say that again?
The restriction of foreign exchange.
What has been what?
The impact so far.
Yes.
Good afternoon. My name is Rena Mafrat for Business Day. You said you're going to be reviewing JP Morgan's delisting Nigeria from its
Sorry, where are you from?
Business Day index. Just wanted to know whether that process has started.
What has started?
The review of delisting the JP Morgan delisting Nigeria from its bond index. Has that process started? Have you started looking at anything? What are you looking at? Starting review. Then on the FX market, you told us, I think at the last meeting, that you're going to effect, or that we're going to be saying a more effective monitoring of businesses to check what goes on in that market. And one of the measures is that you're going to be you asked the BDC to start using BVN for transactions there. Has this process started? I'd like to know.
Okay, that appears to be it.
Good afternoon, Governor. I need some organizations by TM and quite some private.
Sometimes said that TSA has not really. The truth is that yes, they're about the amount that so far is of the newspapers. TSA is an ongoing amount in CBN as at the 15th of September. The amount keeps growing. A lot of people had predicted there was as a result of this. They should increase moderately. We came up with the conclusion that the impact of Nigeria, how safe are from the banks in the TSA. Some of us we have read the governor sometime last week about the most regulated banks. That is, let's go back to the issue of the liquidity shows that Nigeria is still very strong, and we will continue to monitor their liquidity from time to time to ensure that they do not slide into difficult terrain. What has been the impact or restriction of FX in the economy? Certainly, what has happened is that yes, foreign exchange has been, some companies, about 41 items have been excluded from obtaining foreign exchange from the official sources as well as from the parallel market segments of the market. I repeat, the central bank did not and does not have the powers to ban the importation of those items. So the impact as far as we are concerned, I imagine is positive, because we began to see people who before now had closed their factory as a result of the uncompetitiveness of their products compared to the prices of imported items, now opening shops and employing more people, thereby boosting the business in the environment. I'm sure some of us may have read the Erisco tomato paste company. I read an advertisement in the paper that shortly after we announced the foreign exchange exclusion for the importation of tomato paste, they advertised for almost about 1,000 jobs. Just like we have seen that there are many other companies, even abroad, who seeing that it's going to be difficult for them to continue to produce in their country, and export those items to Nigeria have started to consider the possibility of shipping their machines into Nigeria so they can begin to produce those goods in Nigeria. Those are the positives. I must confess that no doubt there will be initial pains caused the people, but we are optimistic that in due course the pains will be relieved. The exclusion of these products from resourcing foreign exchange, as far as we are concerned, creates opportunities for our jobless youths to begin to see this as an opportunity for them to jump into the market or into the various industries and fill the gap that will be created by the restriction on the import of some of those items into Nigeria. So we think ultimately it will help the country, it will help create employment, it will help eventually to boost industry. And that is why we have said in this communique that what we will do going forward is to see how the banks and the Central Bank of Nigeria, being financial catalysts in the banking system or in the financial system, must do their best to see how they can work towards channeling available liquidity to support targeted sectors in the economy. Here we are talking about the real sector, the manufacturing sector, some of those industries that have become moribund as a result of the fact that their products have become uncompetitive with imported items, or to agricultural sector in the area of cassava, rice, maize, and other areas that we believe will substantially boost across the growth in our gross domestic product in Nigeria. Business day, whether we have started to review our position. Well, basically, what we have said is that we've done a 22% adjustment. We've looked at the possibility of whether supply can continue to be boosted, and we are at the mode where what we're doing now is to see as best as we could to conserve our reserves, keep exchange rate stable, but at the same time see what we can do to manage the structure of our demand for foreign exchange. And hence the reason we decided to exclude some of these items that we know can be produced locally. We are currently at that mode, and we are pretty much optimistic that in due course, by the time we are able to achieve a sort of moderation or reduction in demand for imports of these items, because we started to look inwards to produce them locally, demand comes down, hopefully to a level, demand for foreign exchange comes down, hopefully to a level where we begin to say, when we match it with supply, the clearing price will be substantially or above the current pricing. Even if it will be adjusted differently, it will not be it will not be too wide. The variance will not be too wide from the level that we are today. We have said that we will continue to do what can be done so that in due course, as we are able to achieve the balance that we expect, then it should be possible for us to return back to the index. And I repeat that we remain committed. Unfortunately, what has happened, but we owe Nigerians the responsibility to ensure that Nigeria first and Nigerians first. We are going to continue to do our best to ensure that whatever decisions we take are those that will impact positively in the lives of our people, and we are committed to it. We will try as much as possible to play our part as the monetary authorities to do our best to continue to engender growth, create employment for our people, so that we can continue to see economic growth and development in Nigeria. Effective monitoring of BDCs. Yes, the process of effective monitoring of BDCs and indeed other players in foreign exchange market continues. It's an ongoing process. Yes, the BVM issue for the monitoring has not commenced. The BVM registration process will be ending by the end of October. Then after that, we review the position and begin to think of the next steps. Some organizations are exempted from the TSA. Well, the truth is that as far as I am concerned, I have not seen any memo that exempts any institution from the TSA. So as a result, I'll advise those who think that they've been exempted to please avoid creating confusion, because I've not seen any, and for that reason, no organization is exempted, and will appeal to those who are affected by the movement of funds from their bank to the central bank TSA account to please comply. Thank you.